Okay, so in the last class we were talking about, while we were talking about IFRS 9, right? So we have covered a more or less a framework of IFRS 9 where we have looked through staging approaches. We have looked through the basic scope of the assets which are there, which fall under IFRS 9. We have looked through the different stages through it, the way different way of staging is done. We have looked through the different concepts associated with IFRS 9, like such as lifetime PD, next 12 months PD, point in time PD, through the cycle PD, and how is it that these measures they come in together, right? So, and how is it that you reach to your expected credit losses? So basically, when we do our expected credit loss computation, with that's nothing but a product of the PD, LGD, and the EAD. And on the other hand, what we do is, so there are two broad approaches: the generalized approach and the simplified approach. So for assets which do not have a co-financing component, like trade receivables or lease receivables, we use a simplified approach. Whereas for all other assets, we use the generalized approach, right? So the next part that we have is, so basically we had tried understanding this entire framework in terms of the personal loans product, right? So into before we proceed today, right, I would like to kind of like kind of recreate some part of the discussions which I feel should be done in more details, right? We have talked about the assets which fall under the scope of IFRS 9, right? So over there we'll talk about so we will go into a bit details into trying to understand like what are the assets in details in defining the different types of assets in details, like assets at fair value, assets to profit and loss, assets at amortized cost, other comprehensive income, and so on, right? So there are a few important things that I would be talking about in today's discussion, right? So I have created a couple of notes over here, right? I might uh, I'll just write the broad framework, right? And would ask you to just take down some notes today, right? Uh, or if you have a group, or if you could create a group, I can also kind of share it as a photograph, because these are all handwritten notes, and I don't have a document created out of it, right? So that is something we would require to do today. So I'll talk about the asset classes. So I've given you an overview, right? Like what type of assets are there, what is the SPPI criteria, and so on. So we'll talk about this in more details, right? And we'll bring in a kind of we'll show I'll show you this part, right? So I started off talking about the concept of EAD. I mean, sorry, I started talking about the concept of the retail products, right? And we saw that the for the revolving retail products, right, they are a bit different from the SPPI criteria, but still they satisfy the SPPI criteria somehow. So even if revolving products are not I mean, they are not typically an SPPI product, but why is it that they are in within the purview of IFRS 9? That is something that we will be talking about. So there are some basic components talking about the scope of. So we have laid down all the concepts together, right? So I have talked about so we have talked about the type of the scope of the assets, right? And we understand that the personal loan is type of product which satisfies all those criteria, and hence using it as an example we had done that. But in today's discussion we are going to go in deeper to the regulations, and we are going to create a more concrete definition out of it, right? So so that's something that we will be talking about in today's discussion. So each of these concepts that we have talked about, we are going to recreate them. We are going to concretize them in these next few discussions, right? Because we need to know. So we have seen an overview of the regulations, right? So we have seen how the thing happens on the whole. So we now have the boundary created. We now need to dig deeper. So that is what we would be doing, right? So let's start off with a very basic part of this thing. The type of the asset classes, right? The type of the asset classes that uh, fall under IFRS 9. So what type of assets that a firm is it that a firm can place under IFRS 9? And we look into the the financial statement of a firm, and we'll try to kind of identify that which are the assets which would fall under IFRS 9 requirement, and which are the type of assets which will not be a part of IFRS 9 assessment, right? So one of the so over here we'll talk about, or we'll go more deeper into the scope of IFRS 9 impairment. So broadly, IFRS 9 computes the assets or classifies the assets into three parts. Scope of IFRS 9 classification. Now, since it's a provisioning framework, right, it will obviously be computing the classifying the assets basis their cash flows. And there are three such factors. Okay. So the first set of assets that I have with me is the asset at amortized cost. So it is asset at amortized cost. And these assets are computed at their fair values. So it is assets at amortized cost, right? The next set of assets that we have over here is uh, assets which are valued at fair value to other comprehensive incomes. Fair value to other comprehensive. Fair value to other comprehensive incomes. Other excuse me. So other comprehensive, right? Now the next part that we have over here is fair value through other comprehensive income, and the final classification that we have is fair value to profit and loss. Fair value through profit and loss account, FVPTL. through profit and loss. Sorry, FVTPL, fair value through profit and loss. Right. Now, generally, the so we'll define each of them, right? But broadly, it is this assets at amortized cost and the assets at fair value through other comprehensive income, which comprise of the scope of IFRS 9. Right? Every PTL or fair value through profit and loss assets fall outside this. So what we need to know over here is that what exactly is this assets at amortized cost? What exactly is this? You know, what exactly is this uh, fair value through other comprehensive income? What are the kinds of assets which fall under that? And the next thing that we talk about is what type of assets fall under ABPTL and why is it that they are outside the scope of IFRS 9 impair assessment? Why is the impairment for such assets not identified or not computed using IFRS 9? So that's the kind of thing that we are going to do, and we are going to use the financial statement of a bank of an organization, and we are trying to, and what we would try to do is we would try to identify, you know, that what are the assets in that sheet which is available for IFRS 9 classification, right? Because one set of job that is there is to classify the assets appropriately, right? And from there we'll try to understand that how to classify these assets, and how do we know that okay, this is asset A which comes under this, which is this is asset B which does not come under this, right? Okay, so I may not be knowing all the asset classes, right? Because I have worked with a handful of them. So what we'll do is during those process, we'll search up Google, we'll look into what the asset classes are, we'll try to understand whether it satisfies the SPPI criteria, and then we'll look for the classification exercises, right? So let's get started with that. So, but before that, a very important concept associated with IFRS 9 valuation is the concept of fair value, right? Because all the assets has to be appraised at a fair value, has to be appraised at fair value, right? Okay. So the first question that comes out is what is a fair value? Okay, so the first question that comes out is what is fair value? Now, basically, the concept of a fair value is very difficult to, first of all, like have a unique definition of fair value. Now, a fair value is, so basically, I would say that it is the price, that would be received to get that asset, or to transfer that as a liability to someone. So, for example, uh, let's say a personal loan, right? The loan is an asset for the bank and a liability for the borrower who takes it. So basically, there will be a orderly transaction which will happen, right? So there would be no off the book stuff. So everything which is documented, which is on records, and which is done through a contract. So basically, in fair value, so fair value is associated with an orderly transaction. So the transaction, so if you're computing the fair value for an asset, right, it can only be computed for orderly transactions, right? Now it doesn't happen for below the table or under the table activities. So first of all, this transaction must be an orderly transaction. right? So the first and the foremost point is orderly transact, or it's an orderly transaction. Now this must be done between market participants. This must be done between market participants. Now let's say your mom cooks food for you, right? So that is not an asset, or that is not something which can be valued at a fair value. So it must happen at or using or by the market participants, right? The third thing that happens over here is, now for computing fair value, you must have a particular measurement date. So the date at which the asset is being measured. So there must exist a measurement date. So basically, the idea of being a measurement date is that the fair value may change, of the asset may change from time to time, right? So it's a measurement. So there must be a measurement date. So these are the three important factors, right? So these are the three important factors that we have for defining the fair value. So when I talk about fair value, right, so there is an orderly transaction, right? So there is an orderly transaction, there's a market participant, there's a measurement date. Now, given that these three exist, right, the fair value is the price that is received to sell an asset or paid to transfer a liability. So given that these are there, so it is a price which is paid to get an asset or received to transfer a liability. So this is kind of a mutually agreed price, right? Or the market price which is used for that transaction, to that orderly transaction to happen, right, between the market participants at a measurement date. So this is the price which is defined by the very famous demand supply graphs, right? The given the market situations, so you have your zero, you have your output q over here, you have your price over here, right? So this is your demand for the asset, this is your supply of the asset, and this is your market clearing price, right? So which is your q star, and this is your p star. So this is what is the intersection, or this is what happens at the intersection of the so that price which is determined is your fair value. So that's the price which is agreed by the market, right? And now when I talk about the market participants orderly transaction measurement date, I'm talking about a well structured market as an institution which has several, which has clearly distinct rules charted out for that transaction to happen, right? It's a fair market. It's not that there is a lot of information asymmetries which are there, and then what happens is the price is decided, or the price is decided with the gun on the head. So it's nothing like that. So it's a fair market, first of all, right? Now this fair market is perhaps your, like your competitive market, which we study in the economic theories, right? So it's that kind of market that we are talking about, and the price which is determined by the interaction of the agents over there will be your fair value, right? 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 So is this concept of fair value clear to us?
Yes.
Perfect. So now over here, all the assets. Okay. So Mrinma has a question over here that by market do you mean capital market where financial instruments are bought and sold? See, Mrinma, I'm not talking about any physical market as well, right? So a market will be a place where a number of transactions happen. Let's say you go and apply for a personal loan at a price, and that's a mutually agreed price at which you take the loan, right? So that loan or that price of that attached to the loan, right, will be a fair value because that it has been an orderly transaction, right? That loan is valued at a date, as on that date, and the bank and you are two market participants, and you two have agreed mutually on a loan, right? So now, when a number of such transactions on loans happen, I would call that as a personal loans market, right? So, market is a place where a transaction would happen. So, I do not literally mean a market like, as we think about as a vegetable market or as a fish market. So, market would be an institution, or it would be a of collection of transactions of a certain asset, where a certain asset is being acquired or a liability is being transferred, right? Now, even if you think about the capital markets, so there is nothing called such a capital market as such. It's not that you go to a market and do buy the assets as such. So what happens is that there is a listed so there is a transaction which happens, right, and that list of such transactions happening over the capital market is called, so the of capital transactions are called capital markets, right? Right. Okay. So guys, just give me a minute. I'll be back. Okay. Fine. Okay. So all the assets under IFRS 9 has to be valued at fair value, right? Now, when you're kind of valuing these assets at fair value, there are different ways to be done, right? So one type of assets is where the assets are valued at fair. I mean, they are computed fair value at amortized cost. So the question that comes out over here is that what is amortization? So we had briefly discussed as to what an amortization is, right? So we'll talk about it in relatively more details over here. amortization. So, or as we call it at amortized cost. So let's first try to understand amortization. Now, amortization, the concept of amortization is just the, the counterpart of depreciation for physical assets. So, where for physical assets like machineries, plants, equipments, you have depreciation. For non physical assets or invisible assets, you have amortization, right? So, amortization is nothing but the rate at which the value of an asset is written off over time. So obviously, very typically, let's consider that you had taken a loan of 5 lakhs from the bank, right? Now, what you are doing is you are gradually paying off the loan every month, right? So you're paying off the EMIs every month, and while you do that, so obviously, what is happening is your things are going out gradually, one by one, kind of they are going out. So when they are going out, what you can do is, or what you can gradually see is that yes, you know that when these things are gradually going out, you can actually make it out, or you can actually identify that okay, fine, uh, the value of the loan that is outstanding is also depreciating over a period of time. So that loan is being written off at a regular interval of time, right? Now, if that's the case, then there is a depreciation in the value of the asset, and at each measurement date, the loan value is different. That is what we are saying, right? So that's why you need to assess the loan at a fair value. So that at each different measurement date, the value is different, right? And you are kind of writing of the values at a particular point of time. So amortization. So first month you have 5 lakhs. Then first EMI paid you have a relatively lower amount. Next EMI paid you have a relatively lower amount, and so on. So that's the way it goes down, right? So over here, what we have is, so so first of all, uh, so how do we define amortization, or how do we talk about amortization? So first of all is so this is depreciation equivalent of intangible assets. So it is depreciation equivalent. Depreciation equivalent of intangible assets. Right? So it's depreciation equivalent of intangible assets. Now, now what happens in amortization? So you are writing off the you know writing of the value of a fixed asset through a point of time. So you are writing off the value of a fixed asset. So what we are doing is we are writing off the asset at a fixed rate. at a fixed rate. So you're writing off the asset at a fixed rate over a period of time, right? So that's how the amortization actually happens. So the formula. So basically, what happens is, let's say you have a loan and you're writing it off over a period of time. You have a bond for which you're holding a bond for which you are actually gradually paying it off at a period of time, and when the face value matures, you just give it back to the person, right? So that's the way amortization actually happens. And over here, so when you are computing amortization, the question that comes out is, how do we compute that amortization? So we had looked into the formula for computing amortization previously as well, but to today's discussion, we will look into it from a point of view of understanding. So what are the inputs which go in this amortization exercise, computing this amortization? So the amortization A is the principal is P. So P is the principal, right? R. So P is the principal, which is the initial loan amount which has been given. So the amortization is a function of the initial loan amount which was given, or the fair value, the asset recorded at fair value at the time of granting that asset. The next thing it is, the next function is the rate of interest. So it is dependent on the rate of interest. So plus R to the power of n. So over here, your n over here is the number of payments that you need to make, right? So the number of payments, that means that this is where your term of the loan comes into play. So whether you are going to make 36 equal payments, or you're going to make 60 equated payments, or you're going to make 24 equated payments, how are you going to pay that? So that's what we have over here, right? The next part that we have over here is 1 plus R minus 1. Right. So over here, what we get to see is that the number of repayments that you are going to make, right, per period, the amount that you are going to, the payment that you're going to make per period, which is given by the amount, is a function of the initial amount that you have taken, the number of payments that you have chosen, and the rate of interest per period that you have chosen. So when we are looking into amortization, we are not looking into the whole rate of interest, right? Let's say the annual rate of interest is 5%, 12%, right? So it means every month you are paying 1% interest, right? So that's how the amortization is computed. So every month you are paying back a principal, you're paying back the rate of interest, and you've chosen certain number of you choose certain number of installments in which you want to pay that asset. So to the bank, nothing from the bank's perspective, this becomes, or this payment that you are making, this A, becomes the contractual cash flow of the bank. This becomes the contractual cash flow, right? So you see, one thing that we can see is that for assets at amortized costs, right, there is always a corresponding contractual cash flow which goes into the bank, right? So therefore there is a stream of cash flows which is coming over a period of time, and hence this, and given this fact, we can say that assets and amortized costs should qualify for uh, IFRS9 impairment. So assets which can be classified at amortized costs are assets which should actually enter the fund at or which should enter or which would fall under the IFRS 9 impairment classification and impairment analysis, right? So that's the reason why personal loans, mortgage, home loans, auto loans, etc. They all fall under IFRS 9. So any kind of term loans always falls under IFRS 9 impairment classification, right? Because it has this cash flow, and at a given rate this cash flow is gradually written off by the banks, right? So that's what the contractual cash flow is, right? And the next part that is there is the next part that we get to see over here is uh, so the next thing that we need to know is that what exactly are the type of assets, or what are the examples of assets, right, which can be classified as assets at amortized cost. So that is, so the next part is we look into each of these assets, right? So some of the assets is something that we have already discussed. We have talked about personal loans or any kind of term loans. As a part of that, we look into other class of assets as well, which may be there in the balance sheet of the bank, so that we need to identify them as assets which qualify for the contractual cash flows, the cash flow test, or the SPPI test as they call it. Clear? So any questions up to this point of amortized cost, for assets with amortized costs? Yeah. So is this part clear?
Yeah.
Perfect. So now the question that comes out is that this is what the definition of amortized cost is, right? But the question that comes out is that a very typical question at IFRS 9 interviews are that, okay, now I give you a data set, right? Now how do you identify that a particular asset is something which is valued at amortized cost or not? So is an asset valued at amortized cost? So how is it that you can identify that? So that's the biggest question that I have, right? So we need to understand that how is it that an asset, how to figure out that an asset is measured at amortized cost. So over here, there are two things. The first point is, or the first condition must be that that asset is held for a contractual cash flow, right? Now that asset may be a bond, that asset may be an investment instrument, that asset may be a personal loan, that asset may be a home loan, because the bank is holding that personal loan for that guy to get that contractual cash flow, right? So the first point that we come across over here is that, so okay, so over here what we are talking about is, so how is it that we identify that? So identification of the assets and amortized cost. right? So the first characteristic that comes out over here is that the asset must be held to collect contractual cash flows. Asset, so asset held collect contractual cash flows. To collect contractual cash flows. Collect contractual cash flows. So that's the first and the most important thing. So what is the next idea? So over here the next thing is that the cash flow that comes in, right? The cash flow that comes in must comprise of principal and interest, right? So the cash flow must comprise of so it's principal plus interest, right? So cash flow is equal to principal plus interest. So when I have a look into this, so if an asset satisfies these two classifications, these two criteria, we'll know that yes, this is an asset which satisfies the or which is valued at amortized cost, right? So often happens now the question that comes in is how does work come around these parts? The one part may be that your asset. So there are a class of assets that a firm has right on their books, and the way that they have classified it may not be in line with IFRS 9 classification. So the first thing that you need to validate is whether that asset that they have classified is in line with their, you know, is in line with the classifications. So basically, what we need to do is we need to know that okay, whether these assets that they have are classified according to the IFRS 9 standards. So that's the first thing that we need to kind of validate over here, right? So after that is done, the next thing that we generally do is we try to develop. So after that, once the classification is done, then we go on to validate or we go on to calculate their impairments accordingly. Right. So that's the way we generally tend to work. So now over here, what we'll do is we'll look into the kind of assets which are there in the balance sheet of or in the financial statements of a investment company or in a bank, and try to understand whether those assets are, what should I say? So whether those assets are in line with the IFRS 9 classifications, right? So I use the examples of of two companies or two firms which I had previously worked for. I mean, I can actually use them because financial statements are generally public statements which are issued, right? So therefore, they're audited, reviewed, etc. So what we'll do is I'll open the financial statements, right, and from there we'll try to identify there, and we try to see how impairment is reached, how is it calculated, how the classifications are done, and how do we go about doing these things, and what are the type of assets which fall under amortized cost. So a list of assets at amortized cost IFRS 9. Yeah, so over here, just give me a moment, huh? Okay, so what I'll do is, now when I'll save this with me, and I share this about IFRS with you guys. So I'm just sharing the link. So this is the official IFRS 9 website, right? Anyways, so let's first open. Kolkata Insurance Corporation financial statement. Mm, financial statements. Mhm. Statements. immediately. Huh. Let's say here. So let's open this part first. So this was one financial report, which I was a part of the audit, right? So what we'll do is sessions. Let's say QIC December 2018 financial statement. Right? So let's open the statement first. Okay, so can you all see this statement? Okay, fine. Okay. Okay, fine. So is the screen visible? I mean, is the report visible, guys? Perfect. Okay. Now the question that comes out is that, okay, now impairments are kept on assets, not on liabilities. That's the first and the most important thing, right? Now the next question that comes out is, so what are the assets that this firm has, right? So over here, the first thing that we need to know is that cash and cash equivalents. Now, cash and cash equivalents are uh, no are assets, right? But you don't need to keep an impairment on them because they are not receivables. That's the amount of cash, the physical cash that you have, right, at the year end. So, at the end of the year, you have around a cash of around $8 million. So in assets, your cash comprises nearly 8%, $8 million, right? And which has increased from $7.9 million last year. Now the question is, does cash and cash equivalents come under this challenge? I mean, does it come under insurance and other receivables? I mean, does it come under IFRS and impairment? The answer is no, because it's not outstanding. So you have that amount of cash with yourself, and there is zero risk on this. So obviously, I will not be computing uh, the impairment analysis. I'll not be doing an impairment analysis for this. So cash and cash equivalents are out of the story, right? So I'll add a note over here. Does not come under IFRS 9 since it is not an outstanding receivable asset. It is the physical cash with the bank. And hence is a pure asset. no impairment, no provisioning is required for it. Right? So the next part is insurance and other receivables. So this is something we need to check whether this comes under IFRS 9 or not. Right? So we'll go for a check over here. Let me close this. Okay, so over here the next part that we have is IFRS 9, insurance receivables, IFRS 9. So does insurance receivables or are insurance receivables a part of IFRS 9 impairment, right? So insurance, so how is it that expected credit loss for insurance can arise, right? And what are reinsurance receivables? So if you have a look into this asset, right, so it says insurance and other receivables. Also, it talks about reinsurance contract assets. So these are the two important things that we need to look into over here, right? So let's say, so over here, let's look into this IFRS 9 impairment guideline for this particular part. Uh, So one thing that we need to check over here, or among this entire document, right? Our crux of the discussion or a crux of the search would be that whether is this insurance receivables falling under amortized cost, or is it falling under FVOCI, or is it falling under FVTPL? Now, if it is falling under amortized cost or fair value to other comprehensive income, it would be included under the impairment exercise. However, if not, if it belongs to fair value through profit and loss, therefore we will not do it. But I believe, but insurance receivables, because it's a receivable and it happens contractually, right? Because either you give your premiums quarterly, half yearly, annually. So every year, then you renew that premium, right? So so that's where the cash flow for the insurance company actually comes in, right? So over here, let's have a look into this. Okay. Now, the first of all, the most so we define the insurance receivables over here. So how do we define the insurance receivables? So these shall include outstanding premium, fee income from policyholders, clients, outstanding commission, right? Outstanding commission, fee income, and outstanding claims, recoveries from co-insurance arrangements. Now, the first question that comes out over here is that, first of all, does this satisfy the two criteria of amortized cost that we had talked about? So over here, now insurance is generally done for a certain term, like if it's a term insurance is done for a certain period of time, right? And the premium comes in every year, so or at a fixed time interval. So if I go back to this definition of or to this part, so the A is the insurance or the amount the premium that you are paying. P is the amount of insurance that you have looked for, right? So that's the initial amount of insurance that you have. The next part is R, which is the rate of interest, or which is your premium rate. And N is the number of times you are making the payment in a given period of time. So in a year, if you are paying it so once in a year, so N is 1. If you are paying it uh, you know twice a year, that's so 4 times a year, that's quarterly, or you're paying it half yearly, whatever you are doing, right? So that is what N is. So obviously we can see that each of these concepts of this is done. However, when I talk about premium, right, the SPPI does not get a one-to-one match, because in insurance you don't have interests, right? What you pay out is a premium based on your riskiness. The more risky borrower you are, the more higher your premium is. But over there you do not have the concept of a principal plus an interest, right? So all you have is a premium, which is paid contractually. So we can see that almost closely this resembles the the definition of uh, you know of an asset at amortized cost for you for the insurance companies. Right? But the question that comes out over here is that since it's a receivables, right, and there is no interest component, right? So there is, so will this apply for a kind of a generalized approach, or kind of would it apply for a simplified approach? So how is it going to be like? So that's what we need to understand, and we need to, so that is where the IFRS 9 regulations for insurance receivables come in, right? So is this part clear?
Yeah.
Okay, so let's go back to this part. So the insurance and other receivables and reinsurance contract assets. Okay. So first over here it says that these are the different types of the receivables for insurer, right? And what are insurance receivables? It contains includes outstanding premium, the fee income from policyholders, outstanding commission of fee income, outstanding claim recoveries from co-insurance arrangements, right? So similarly, reinsurance receivables are the claims which are recoveries which are outstanding from the reinsurers. Okay. Now now the other parties which are involved over here is investment receivables. Now, if I look into this banks, so you will see that there is such as investment, right? So which was done. So let's have a look into this. Now, investment receivables are receivables, income receivable from an investment asset, that is property, debt, equity, instruments, etc., that are outstanding and past their due dates. So we'll come back to this investments in later in at a later time. Okay. Okay. Now this is something which is important, right? Because over here, you get to see the rating risk scoring of bonds, right? So how is it that the bonds are risk scored? So what are the quantitative measures? What are the qualitative measures? Right? And based on that, you'll also get an idea about how is it that what should I say? So how is it that this falls under IFRS 9? So which are the bonds which falls under IFRS 9, and which are the ones which do not fall under IFRS 9? Right. So that is something that you will get an idea of. So what I'm doing over here is I'll save this. IFRS 9 impairment assessment for insurance companies. Yeah. So as I was saying, so obviously yes, insurance and other receivables come into our purview because since these are contractual receivables which are expected to be received over a continuous period of time, therefore since the contractual receivables which are expected to be received over a continuous period of time, therefore what we need to do over here is, what we need to understand over here is that this should be done so therefore there will always be a challenge. So therefore there would be a risk. So there would be a risk for so since these are contractual receivables, so there would be a risk of default. Hence, provisions need to be maintained. Hence, the provisions need to be maintained and then under the IFRS 9 standards. Under the IFRS 9 standards. Right. So that is something which is important. Now, obviously, over here there are reinsurance contractual assets, equity accounted investments. Now, when I talk about investments, right? Now, investments are something which is, so investment is something which is or which needs to be maintained, right? Or which investments are something which is done by the QIC company or by this insurance company into other companies as well, into other investment firms, investment banks, etc. Right. So basically, therefore, these investments should also come under, or investments would be coming based on the type of the investment that has been done. So whether that investment brings in a contractual cash flow or not. So based on that, the impairment would be computed. Right now, in what type of bonds are you actually investing? Because that bond is giving you a income flow, right? A contractual flow, a continuous flow of income. Now, if there is a counterparty default which occurs over there, then the cash flow would hit us, right? And that would lead to an impairment. So there is a credit risk which is involved into such assets as well, right? Now, property and equipments are obviously not a part of this, right? So they are obviously not a part of this. What should I say? Not a part of IFRS and impairment assessment because their properties and equipment, they're physical assets, and all they can go through is depreciation. you need not have any outstanding with them, right? So they just go to depreciation, they're written off every year, and you have the amount reducing. So over there, right, the investment properties are so investment property and property equipment will not be coming in over here. Now, what comes in the next thing that talks about is goodwill and intangible assets. So, does goodwill and goodwill and other such reputation and other such factors lead you to, or do they give you a contractual cash flow? So, if it gives you a contractual cash flow, we will look into goodwill. But as far as my understanding goes, as far as I remember, right, goodwill is outside the scope of IFRS9 impairment because goodwill is something which is subjective, right, and you do not have any specific asset which is given. So there is something which is your goodwill. You value that, and that brings you your money. But what exactly is that goodwill? So there is no such assets, or if I go by that transaction, goodwill does not have a fair value, right? So you cannot. So there is no proper market where goodwill is transacted, right? Because there are no market participants. There is no finite asset which is traded. So goodwill is something which is intangible in nature, right? So it may spread to the word of mouth and so on. So basically, ideally, goodwill should not be coming under IFRS 9. So under IFRS 9, receivables which or assets which bring in physical receivables, right, and they bring in contractual receivables, and if they don't come in, the there would be a contractual loss, right? So so what they do is so basically a loss of goodwill is not going to give them a contractual a loss in the contractual income, but it is going to hit them or what you're going to get is a one-time shock. So this is precisely how it needs to work. Right. Yeah. So over here what we have is so over here what we get to see is that so goodwill should not be a part of IFRS 9. Anyways, I just check for that goodwill. Okay. So over here for insurance companies, insurance and insurance receivables, right? You can see that it says that if it's cash, right, it's valued at amortized cost and IFRS 9 impact not material. So obviously you can leave it out, right? And equities obviously is not available. So if you have a look into this, if you go back over here, right, so you see that there are accounting equity accounted investments. So this is obviously outside the scope of IFRS 9 impairment analysis, right? So this is outside the scope of IFRS 9 impairment analysis, since equity investments are typically classified as the fair value uh, profit and loss. It's FVTPA. Right. So over here, what we get to see is that equity accounted investments do not form a part of this because they are primarily fair value through profit and loss. Clear? Any questions up to this point?
No.
Great. Okay. So now over here, uh, so I'll just do this check once. Goodwill and intangible assets. Okay, fine. Is goodwill within the scope of IFRS9? Okay. Okay, so it seems that goodwill has a different treatment under IFRS. So let's keep goodwill out of the point of it's out of the point till now, right? So I'll just put goodwill and intangible assets. So we need to check, need to clarify. So I'll do this for you, right? You need to clarify. Fine. So for assets, this is so much is for assets. Now 39,164 and 34,734. So these are your assets. So one thing we can see from the financial statement as an investor is that yes, your assets have gone up. And over here, once we look into this, the liabilities where you don't do impairment for liabilities, right? So basically, all you need to do is because in liability you are on the borrowing side. So the people who have lent out to you are the ones who should be worried about it. So over here, what you have is provisions, reinsurance, and other payables. So this is the provisions that we are trying to make out, right? So is that provisions that we would be trying to make out going forward. Now there are other values, right? Like we have seen insurance contract liabilities. Uh, then you have shareholders equity, right? So you have equity, capital, the general reserve, foreign translation reserve, and so on, right? Right. Now over here, so over here we have some of the important features that we have. Now, this part is your consolidated statement of income. So, this is your kind of income expenditure statement, right? So, it's kind of your profit and loss statement, which computes. So, at the end of the year, yes, you are computing the profit, right? Now, when you're computing the profit, there is this other comprehensive income, which needs to be adjusted. And this is where we come across the next set of things. So when we talked about insurance receivables and other receivables, we saw that they were assets and amortized cost because they are contractual in nature and they keep on flowing. But one very important part is that they are simple receivables. They are not the kind of receivables that we talk about in personal loan, because the receivables comprises only of the premium, right? It does not have a financing component like an interest component attached to it. So you need not decouple the principal and the interest over here, right? You can use both the simplified as well as the generalized approach for this particular asset, right? So we come to the simplified approach, the generalized approach. But for assets which have, kind of principal and which satisfies the SPPI criteria and has both principal and interest, are assets which are valued at, or so those are the assets which are valued at amortized cost and has to be applied, and an impairment has to be computed by applying the general approach over there. Clear? Okay, so over here, when we come to the income, right, we come to other comprehensive income. So that is the second classification of the assets that we were talking about. FVOCI, fair value other comprehensive incomes, right? So let's go back and let's talk about FVOCI a little bit, right? Let's see how it is defined, and from there we'll talk about the next part. Okay. So if you want me to stop somewhere, you want me to ask some like give you some time to think about what we have done, what we have talked about, then do that. I'll stop for 2-3 minutes, go through it. You guys go through it, and then we'll again get started. Okay. So having talked about IFRS 9, right? Having talked about the assets and amortized cost, the second group of assets that we generally talk about over here is the fair value to other comprehensive income. The next part that we have over here is the fair value to other comprehensive income. OCI. OCI stands for other comprehensive income. So before okay, so let's do something before I start off with FVOCI, right? Let's just take a small break, right? And let's regroup at around 11 a.m. to take the discussion forward. Right, so let's just give me some time, right, because I've been talking for quite some time, so I just a small break helps me. So let's regroup at 11 and let's take the discussion from there. Hey, hi guys, am I audible? Can you hear me? Perfect. Okay, so let's get started. So before I move on, let's quickly recap whatever we had done, and then we'll come back and we'll start with the next portions. So we talked about the amortization part, right, where we said that for amortization to hold, right? So so for an asset to be identified at amortized cost, number one, the bank or the final, like, the asset must be held to collect contractual cash flows, right? And the cash flows should comprise of principal plus interest, right? And then such an amount, and so basically that asset which is held for collecting cash flows and and satisfies the SPPI criteria is an asset which is identified on amortized cost and is to be assessed using the general an impairment on that asset for IFRS 9 is to be assessed using the generalized approach, right? So that's what we said. And to substantiate that, what we did was we went to study the financial statement of one of a insurance company called the Qatar Insurance Corporation, right? And we saw that basically on the asset side, right? So impairment is computed for assets, not for liabilities. So on the asset side, we saw that it was the cash and the cash equivalents which were there, insurance and other receivables, right? Reinsurance contract assets, equity accounted investments, goodwill, and intangible assets. So over there, we know that cash and cash equivalents are not required, say, like, they do not come under IFRS 9. Now, even if they come under IFRS 9, I would be doing them under or evaluating them under amortized cost, but the impairment impact on them is absolutely marginal or negligible, because cash is not something which contains this risk, right? So it is not an outstanding receivable asset. Hence, provisioning is not required to be calculated on cash. Even if you calculate on it, it contains very negligible impact, right? So that's one. The second that we talked about over here is the insurance and other receivables. Now, obviously, yes, we saw that these are contractual receivables which are expected to be received over a certain period of time, and therefore there would always be a risk of default on the other counterparty. Hence, provisions to be maintained under IFRS 9. It is a contractual cash flow. However, it may not be exactly the same as the SPPI criteria, because in insurance you have even if you have premium receivables, it does not come with any interest component, right? So for these receivables, both, number one, the simplified approach, and number two, the generalized approach, are created. Now, approach can be used to compute the expected credit losses. Right, so this is goodwill, and so that's basically it, right? On the other hand, we have looked at investment properties. So basically these are fire. So now, depending on the nature of the investment that it is, we can compute the we can see whether which are the type of investments on which we should kind of is keep aside. I mean, we should keep aside the impairment, right? And obviously, for property and equipment, it does not really hold good, because for property and equipment, what happens is, so these are physical assets, and hence not much of required in both for investments and investment properties and property and equipment, because these are physical assets. However, investments, yes, for investments there are there would be, so assuming that if the investments are in bonds and other assets, then you need to look into those bonds, you need to look at the yield, and need to look into the ratings and decide as to how this investments can be, or the impairment on these investments can be done. Now, for goodwill and intangible assets, ideally I believe they should not be coming under IFRS 9, because there is no contractual cash flows involved with it. But what we'll do over here is, we need to just check this out, because there might be some other way. So that's what we need to clarify. Right now, on the liabilities and the shareholders side, now these are something which is, uh, you do not, so what you don't do is, you don't like keep impairment or keep provisions for liabilities. You just keep them on assets, and hence the liabilities are not going to come under the IFRS 9. Now, on the other hand, what we have is a shareholders equity. Equity is equity and other assets. So they come under, so most of them are, uh, so what should I say? Uh, so they are kind of, so equity is a part of the fair value profit and loss, and hence obviously it's capital, and it's a part of liability, and hence it does not enter into this particular assessment, right? So over here, so the next part that we look into is the different sources of the income, right? And from there we move to this particular part where we talk about the other comprehensive income, or the FVOCIs, fair value or other comprehensive income. So this is the part that we need to assess, right? So what are the type of instruments which come under other comprehensive income? That is something that we need to talk about in our present discussion. And that's where we first define the other comprehensive incomes and move, and from there we move on to the next. Okay. So talking about fair values and other comprehensive income. So first of all, let's now, one thing is sure, right? So one thing you can clearly understand is, what is this through other comprehensive incomes. So other comprehensive income. Now the first question that comes out is like, what type of incomes are defined as other comprehensive income? So over here, so basically these include, revenues and expenses which are not included in the income statement. So these include revenues and expenses, revenues, expenses, right, gains and losses, gains losses which are excluded from gains and losses which are excluded from the income statement. From the income statement. Right. So this is excluded from the income statement. Right. So over here, the next part that we are going to take up over here is the following. We'll talk about so what are the type of this income, or what type of income fall under this. Now obviously the other comprehensive income, the such incomes which do not impact the income statement but they impact the balance sheet. So first point is does not impact the balance, so they impact balance sheet. Impact the balance sheet. Right, so they impact the balance sheet but they do not impact. Okay, so do not impact, so it impacts the balance sheet but it does not impact the income statement. Does not impact the income statement. Right. So these are the type of incomes. Now what happens is so what are the type of incomes which would uh, would not impact the income statement? Now, one very important characteristic of the heads in the income statement is that the income statement comprises of realized incomes, right? However, there can be some income heads which are not realized, so they are unrealized, but would be realized in the future. So when you have prepared the income statement, though they do not come in the income statement, but they would go and impact the balance sheet, right? So that is the reason why such unrealized incomes, right? Then foreign currency translation, unrealized gains and losses on post-retirement benefits. So these are the type of incomes which fall under other comprehensive incomes, right? Now, now obviously because they are not realized, there is a risk involved with them. That is the reason why these you need to keep an impairment, or need to keep an provision for these assets, the fair value through other comprehensive income. So that's FVOCI. Right. Right, so am I clear on this part? Just check. So, are you clear with this idea of other comprehensive income and why other comprehensive incomes are eligible for impairment analysis? And the third is, why is it that the other comprehensive incomes do not impact the income statement but they impact the balance sheet? Why? So, is this part clear or not?
Yeah, Tanmay, this is clear. So the question I have here is right now, so wherein the role of time series analysis comes in?
So, the time series analysis comes in when you are trying to feed in the macroeconomic variables to make the uh, point in time PD forward looking.
Okay.
So that's where the time series analysis would come in. Because at the end of the day, when you are looking into, right, so when you're looking into the behavior of the variable, right, so that's where the balance sheet, so that's a time series variable, right, provisioning over point in time PD and all. So now you are putting in macroeconomic variables. So what you need to do is you need to predict the macroeconomic variables over the next some period of time, and then you need to put it down. Right. So when you're predicting the macroeconomic variables, that's where your time series models come into play. Right, Anshu? Let's say very easily. Over
Yeah.
here we are creating the Z score, right? But what we are doing is we're creating the forward looking estimates, and based on that we are computing the Z score, right? So when we are doing that, that ZI minus two plus two, etc., is so this prediction. First I'm predicting the macroeconomic variable in the next 5 months, 10 months, or let's say 5 years, 10 years down the line, and then based on that I'm computing uh, the Z scores, right, for the severely adverse scenario, and so on. So basically, let's say design an adverse scenario. So what is going to be the output? So I need to know the equation that connects the respective macroeconomic variables, and that's where your time series model comes into play,
Okay.
right? So over here, so time series would be coming in when you are predicting, right? So over here, we have not gone to that problem of predicting right now. We are focusing on the classification of assets. Key, I need to first create my data set, right? So given an investment portfolio, but how do I know that which of the assets should enter into my model, or which are the ones on which I'll compute my ECL? I need to identify the heads first. Then I'll go and compute the ECL for them separately, right? So that's the classification part that I'm talking about right now. So the time series and all, they will come at the point when you're computing the impairment, right? Is that clear,
Yeah.
Anshu? Any other confusion?
Yeah, Tanmay. No, that's fine.
Perfect. Okay. So Minmoy has a question over here. So Minmoy says, please explain the impact of the balance sheet, but do not impact the income statement. Fine. Okay. So to understand this, Minmoy, just have a look into. Let's have a look into this income statement. Now, what is the income statement? The income statement for this insurance company shows the realized incomes, right? The gross premiums that have been given, right? So that has been received by the firm. The net premiums that have, so you are adjusting the gross premium to the premiums ceded to reinsurers. So what you have is a net premium. Then you have gross claims paid. So these are net earned premiums. Insurance, reinsurance recoveries, movement in outstanding claims. So these are what? Net commission, other insurance incomes. So what are these? So these are realized incomes, right? So these are the incomes which you have actually got, which has come into your income statement. But now there can be some recoveries which has been done but is still not realized, right? Or which is still in the process. Or let's say some commission fee which is there, which you have gone but you have not earned. So where there is still a receivable. So this is very much an income which is coming to you, right? Which you are due of. But it may so happen that the person who is supposed to pay you the premium differs. So that's why unrealized incomes, right, or other comprehensive incomes needs to be evaluated at fair value and impairment to be calculated on them, right? So if you go to the next statement, so that's why this will not impact the income statement, but this will impact the balance sheet. Why? Because these are some of your assets which are to be realized, and the realized asset, realizable assets will appear on the asset side of your balance sheet, right? So if they are realizable, there has to be an impairment computed for them. I mean, a provision computed for them. So that's the reason why these unrealized incomes will impact your balance sheet, but not the income statement, right? Clear on this part? Fine, great. So let's look into the case of where what type of an asset or what type of other comprehensive incomes feature for this insurance company. The first is debt instruments at fair value to other comprehensive incomes. So that's the first thing. So if you have some debt instruments at fair value to other comprehensive incomes, that is the part which is, so this is applicable for IFRS 9. So you have some debt instruments, right? So you have what, say, debentures in another company. Now you know that every month or every end of every year this is going to come in. But the day when you are preparing your balance sheet, that has not come in. So that's your realizable income. So that's your other comprehensive income. So this is an asset through, so this is an asset which is FVOCI. Therefore, therefore, this falls under the purview of IFRS 9 impairment calculation. Right now, since it's debt instrument, since it is a debt instrument, QIC is uh, supposed to get, so QIC is supposed to get the following: is supposed to get the principal of the debt instrument plus the interest on the debt instrument. On the debt instrument, right? Hence, the general approach should be applied to compute the resulting ECL. right? So over here, this is one typical asset which is to be evaluated using IFRS 9, the impairment of IFRS 9. Now, available for sale financial assets. This is a very important class that we need to know, right? So this is something that we really need to understand: assets for sale and the debt instruments for other comprehensive income, and we need to know that what type of assets come under this available for sale financial asset, because the assets which are available for sale financial assets are something which you need to keep aside for or which would apply for IFRS 9 impairment exercises. So that's something that we need to take care of. So available for sale financial assets. So AFS financial assets are FVOCIs and hence are applicable for IFRS 9 impairment exercises. Available for IFRS 9 impairment assessment. Right. So obviously again you have foreign currency translations and net change in values and so on. So this is the total comprehensive for the period. Right. So change the statement in equity. So this is not something that we require. And from here, so now if you have a look into this, you can actually find out that okay, so where is it that an impairment must go into? What are the values for which your impairment exercises must go in? So one of the impairment component is this. So this part shows the impairments which needs to be done, or the impairment heads, right? So provision for employees and the service benefit, that's not impairment, that should be computed. Right, and over here you have the details of the descriptions and everything which you can actually go through, like once you require, like so IFRS 17 insurance contracts and what are the so over here you have the notes, right? 16, 17. So what are the notes and everything? So I like why is something coming under IFRS 9 and something is not coming under that? So you have goodwill treatment over here, which has been discussed, right? So all the standards that are applicable over here has been summarized as notes over here, right? So this is something that you can go through, right? So what is equity investment FVOCI? What do you mean by financial asset for profit and loss? Then data instruments are FVOCI. So all these things that you want to know about the description of the concept, so they have been added as notes at the end of the financial statement. Now this is done to ensure transparency of the definition, so that the auditor can look into this and he can go back to the figures and see how the classification has been done. So that's the way this thing is actually done, right? So any calculations, any computation that you want to know, you can see over here. Any adjustment which has been done, that is seen over here, so on. So this is basic broadly how assets are classified, and the assets are chosen. It's chosen that which is the asset that I would use for or compute at an amortized cost, and which is the asset that I would compute it at fair value, as fair value through other comprehensive income, right? So this is as far as the classifications are concerned. So given any asset, we should be in a position to identify that that how is it that they should be classified, right? But one key exception to this, right, is the revolving products, because whatever we have discussed till now does not speak about revolving products. Like let's say there's a bank which has a credit card, that's a revolving product, right? Now, given that it's a revolving product, what we need to do is we need to know how this is work, or how is it that it should be done. So over here, we need to talk about the concepts of the revolving product. Revolving products. Now, revolving products are nothing but they are products like credit cards. Then you have products like overdrafts and so on. But the problem with revolving products is that they do not have, even though you keep on getting a contractual payment, but there is no fixed term for that payment. Hence, it does not satisfy all the properties of uh, what should I say? It does not satisfy all the properties of uh, how do I put it? All the properties of the SPPI criteria, right? But it has a contractual payment, and hence the risk is, I mean, provisions. It falls under the IFRS 9 impairment analysis. So, what is most important is to understand that how this particular product would work and how is it that we can compute the different estimates. Like we can compute the next 12 months exposure at default. How is it that we can compute the next 12 months ECL, uh, lifetime ECL, and so on. So, how do we do that? So, that is something that we need to understand over here, right? So let's keep it here for the day, right? So we have done the financial statements. Let me send over this financial statement to you with these explanations. So go through that, study the financial statement very nicely, try to get a hold of the way asset classifications are done, right? So in the next class, we'll talk about revolving products, and from there, we'll talk about how to compute the respective components, how to zero down on whether it should be a generalized approach or it should be a simplified approach, kind of a thing, right? So we'll first look into it in terms of the insurance company, then we'll move on to other financial statements, right? But over here, yes, assessing the financial statements of the firms would be a very key exercise that we would carry out, unlike what we do in CRM, because over there we are looking more into the quantitative side of things. Over here, we are looking more into the regulatory and on the business side of things. So over here, this financial statement and analysis, uh, description, and all these parts to reconcile those financial statement figures, the classifications, along with the footnotes, would be a very important part of our discussions going forward in the next 2-3 sessions, right? So let's take a pause here for the day, right? Let's go through that. I'll send over this. Your recordings are updated. I've updated all the recordings. I'll update this as well today itself, as well as I'll share over all this, all of the board works with you guys, so that you can kind of go through it.
So you have shared the link for the videos, or
Yeah, it's the
it's
same link. It's
on
the
the
same link.
same link?
It's the same link.
Same link.
The link is the same. You just need to go and refresh it. You'll get the updated recordings.
Okay.
Right? Okay. So thank you guys. Thanks a
Yeah.
lot for your time. And let's catch up tomorrow. So tomorrow we'll be doing our CRM sessions.
And we do we have CRM now?
Uh,